So you've accomplished something remarkable. You've gotten your budget under control, you've created a savings plan, and you are currently maxing out your 401k. That's an awesome accomplishment, an enviable one at that. But just because you can max out your 401k doesn't necessarily mean that you should. And that begs the question, should I be maxing out my 401k? Well, instead of going off of cliches or popular opinions, in this video, we crunched the numbers. We ran the math to show you what would happen. So let's look at it together. You ready? Let's jump in. So you don't have to go far online to be bombarded with recommendations about your 401k. All over the internet, we are encouraged to max them out, to put as much money as we can into them. And I want to be clear, 401ks are not bad. But what we wanted to ascertain was, is there a certain amount of money that if put into a 401k could actually cause more problems than it's worth? But for our case study, let's just assume that the person is saving using only their 401k. We'll call them John. And let's say John makes about $100,000 a year. Now, John is contributing $19,500 to his 401k. And if those funds grow at a rate of 7%, John will end up with $1.9 million inside of his 401k in 30 years. So what do you think John is going to do with all of the money that he has worked so hard to save? Well, obviously, he's going to spend it. So he begins to take distributions from his 401k, and we'll assume he's going to take about 5% of his balance each year. Now, you're probably wondering, why are we taking that percentage? Well, it really has to do with the safe amount of money that can be accessed each year from your retirement account. We actually published an article that just highlights how this rule works. Some people don't think you should even be withdrawing 5%. They'll say it should be 4 or 3. But in this example, just to be fair, we're going to assume a 5% rate of return. So they're going to withdraw 5% a year. That's about $95,000. In addition to that, we're going to assume that John has a $30,000 Social Security income. So he's spending about $125,000 a year. But because none of the money inside of his 401k has been taxed, the question we need to ask is, how much is he going to pay in taxes each year? So let's take a look. So in federal taxes, he's going to pay about $13,000 a year. In state taxes, he's going to pay about $5,000 a year. That's a total of $18,000 every single year. So in 10 years, he will have paid $180,000 in taxes. In 20 years, he will have paid $360,000 in taxes. And in 30 years, he would have paid over $500,000 in taxes. And if he lives longer than that, he will continue to pay taxes every single year. But it gets worse. What if John's wife passes away? See, in this entire example, John was married, right? So the tax rates for a married person are more favorable than they are for a single person. So if John's wife passes away at some point while he's taking these distributions from his 401k, and for whatever reason, he needs to keep his income the same. See, it's not automatic that his income is going to cut in half because of there being one less person in the house. The rent won't change, or the mortgage won't change if he still has one. Certain utilities are not going to change. So if he needs to keep his income the same after his wife has passed away, he's going to pay a higher level of tax on less income. So if we look at the amount that he would pay each year, he's going to pay $24,000 in taxes. In 10 years, that's $240,000. In 20 years, that's $480,000 in taxes. Now, some might be thinking to themselves, well, you know what? I know how to avoid the tax. I'll just withdraw less. I'll make myself live on less money so that I don't have to pay the taxes. Or I'll let some of this money stay inside of the account so that I don't have to pay taxes on it. I'll pass it on to my children. Well, there are two rules that directly oppose that line of thinking. The first one is the required minimum distribution. Now, the required minimum distribution is the minimum amount that the government requires be withdrawn from your retirement plan each year. So this amount, this percentage is going to force you to take distributions from your retirement account, even if you don't need the money. Why? Well, because the government has never gotten paid the taxes due on this bucket of money that is continuing to grow. So even if you tried not to touch the money because you didn't need the income, you're going to eventually get to the point because of required minimum distributions where you're going to have to take it. Now, the second rule that'll stop you from just leaving the money inside the 401k is this inherited IRA rule. The way it used to work is that if your children inherited an IRA from you, they could take distributions from that IRA as they needed them at whatever pace they wanted to, which worked because if they were in their prime working years, they wouldn't want to take large distributions because it would increase the amount they owe in taxes. Well, all of that went out the window, and now we have a 10-year rule. So when your children inherit this money that you saved inside your 401k, they have 10 years to completely withdraw all of the funds inside of this account. Why? Well, once again, because the government wants the tax revenue. So think about it this way. Let's say you stop withdrawing money from your 401k or you reduce the amount you withdraw each year. And now the money in your 401k continues to grow. You pass away, it's left to your children. Your children will now need to withdraw from that 401k. So let's say your son, let's say John's son makes $100,000 a year, just like his dad. And let's say he decides that he's going to take even distributions from the 401k of $190,000 because he only has 10 years to spend it, right? Now, because of that, he'll have to pay $50,000 a year in federal taxes, $70,000 in taxes if he's single, meaning if he's not married yet, $14,000 in state taxes. That means in year 10, he will have to have paid $650,000 in taxes. So we can see the conclusion of having all of your money tied up inside of your 401k. The issue that you're going to run into is you are going to end up paying a significant amount of money to taxes. You have no tax flexibility. And we could add to it, you also don't have any liquidity either, because God forbid, if you needed access to money before you got to retirement, all of your money being tied up inside of that one asset would have severely restricted you. But what if we had John do something different? What if instead of having all of his money tied up in his 401k, what if he decided to diversify, to use a strategy known as asset location? That's basically where you try to build a portfolio of assets that have different tax treatments, right? You are concerned not just about how your money is allocated in the stock market, you're concerned about how your money is allocated for tax purposes. So in this example, let's imagine that John put $5,000 into his 401k. He put $6,000 into his Roth IRA, and he put the other $8,500 into life insurance. Now, just to be clear, we are not encouraging John to go out and buy $8,000 of life insurance. That would not help his situation. But life insurance is treated as tax-free under the tax code as long as certain rules are followed. And life insurance can be designed so that the overwhelming majority of the funds go into a cash bucket. So you can squash the life insurance. You can wrap the smallest amount of life insurance around your cash that the IRS allows to be done. Everything else goes to a cash bucket. That cash bucket grows based on how the market performs. If the market goes up, you can capture a positive rate of return up to a certain point. If the market goes down, you don't lose money. I have other videos that explain how life insurance can be used as a place to save and grow money. But the reason we have it here is because it is a tax-free asset, just like the Roth IRA. So let's see what happens if he does this. If he does this, and let's just say he averages the same rates of return. If he just averages that same 7% inside of his 401k, He'll have 486,000. Forgive my horrible handwriting. And if he averages that same 7% inside of his Roth IRA, he'll have 584,000. And then if he averages the same 7% with his life insurance policy, he'll have 827,000. And you know what? Now that I'm thinking about it, it's not fair to assume the same rate of return with life insurance that you would with these other asset classes, because honestly, they're taking on more risk. So you would hope you would get a better rate of return. So let's lower the rate of return. Let's just say 6% for this example. I know some may think that I should choose a different rate of return, but we're not focused on the rate of return right now. We're focused on asset location. So let's just assume 6%. If I can get this to draw here. Okay, here we go. Then they would have $689,000 inside of their life insurance policy that can be accessed once they enter retirement and need to create income. So we can see that now, instead of having all their money tied up in one basket, John has some tax diversification. So let's look at what would happen when he's now ready to create an income for himself in retirement. That 401k balance of 486,000 can produce an income of about $24,000. That Roth IRA would produce an income of about $29,000. And the life insurance would produce an income of about $42,000 a year. Now, you're probably looking at the rate of withdrawal or rate of access to funds, and you probably noticed that the life insurance withdrawal or access rate, should I say, is higher. Right? We're using like a 6% rate of distribution from the life insurance policy. And the reason why that's higher is just simply because the rules that limit what you can access from your 401k and your Roth IRA do not apply to life insurance. The reason you have to restrict how much you take in any given year with your 401k or your Roth IRA is because it is exposed to market risk, meaning you can experience big losses. So you have to keep your withdrawal rate low so that you can weather the ups and downs of the market. And while it's true you can get a 0% rate of return inside of life insurance, it's not nearly as volatile as traditional investments. And as a result, you can distribute a higher percentage of those funds each year. So we just chose the distribution rate of about 6%. So if you do that, you'll have about $96,000 a year, which is maybe $1,000 more than you had in your 401k. And that's not including the Social Security. So you're back at your $125,000 a year. Now, here's where it gets really exciting. Remember how much you paid in taxes before? You paid over $500,000 in taxes over the life of your account. You were paying about $19,000, $20,000 in taxes a year. Because you diversified how your accounts are set up, look at the amount that you're paying in taxes now. Significantly less. Significantly less. And the reason why is because instead of having all of your money in a tax-deferred environment, you now have tax-free assets that you can withdraw from. You know, if we really get technical with this, we could probably reduce this tax burden even more. In fact, if we just reduced the amount that we were withdrawing from the 401k here by about $10,000, maybe if we only took $14,000 here and we took additional funds from somewhere else, you know, we could get the federal taxes all the way down to $300 a year and the state taxes possibly to even $150 a year. Possibly even, we might even be able to eliminate even more of these taxes. Now, once again, the reason this is possible is because we have diversified our tax position. That's less than a 3% tax on the $125,000 of income that you have coming in, all because of tax diversification. Okay, but I know what some people are going to say. I know what they're thinking. They're going to say, but you're not factoring in, Jason, all of the money I would have saved over my lifetime because I put money into a 401k and I got that tax deduction today. You're not factoring that money in. I didn't get as much in a tax deduction as I would have. And that's true. That's true. So let's look at the tax deduction that you would have got. All right. So if you were married, so in this case, John was married. All of the examples we did showed John as being married. John would have saved $70,000 in taxes. That's the amount he would have been able to receive, not just in 1 year, over his lifetime. So it's about $2,000 in tax savings a year. But it's important to remember this point. This is the point that always gets lost in translation. This $70,000 you supposedly saved was not really saved. It was a tax deferral. You basically told the government, hey, if you give me this $70,000 now, I'll give you this $70,000 back later. Plus, I'll give you taxes on all of the money I make on my investments, on my savings as it grows. So this $70,000 of tax savings, it's important to remember what it turns into when you go to access your money. It turns into 180,000 in 10 years. It turns into 360,000 in 20 years. And it turns to 541,000 in 30 years. So what's the point of this video? Is this video designed to say that 401ks are bad? No, that's not what we're saying. We're saying that if you have all of your money going into one account, a 401k, and that's the only place that you're saving, you could put yourself in a situation where you could pay way more in taxes in the future than you're supposedly saving now. And mathematically, there are benefits to reducing those contributions in your 401k and then contributing to other asset classes like Roth IRAs or even life insurance. So hopefully this video, hopefully the numbers we delved into really helped you to see why we are huge proponents of tax diversification. You're going to save a whole bunch of money on taxes, whether you spend that money, whether you pass it on to your beneficiaries, or any other situation that may come up, you'll have a ton more flexibility. So hopefully this video helped. Until the next time we talk, take care.